Hey everybody, thanks for joining me. Today we are going to talk about some stocks that have been heavily shorted by investors that I think actually could be some great long-term investments. Before we dive in, please take a minute, check out the link you see on your screen, fool.com/Frankel. You can get the top 10 stocks to buy right now from the Motley Fool. It's the best way to support this work I'm doing on YouTube. So again, that link is fool.com/Frankel. Check it out today. So there are three stocks in particular I wanted to talk about. There are a lot of heavily shorted stocks in the market, but these three seem particularly intriguing as short squeeze targets and also as really good long term investments. I own two of them in my personal portfolio, just to say that up front. So I have put my money into some of these. The first one is the most heavily shorted of the three. That is Upstart. Upstart, ticker symbol UPST, has a 37% short interest. That means 37% of shares available to trade are currently sold short by investors. That's a lot. So it's not hard to see why. The recent results aren't encouraging. Revenue's down 37% year over year in 2023. The company is losing money. It was formerly profitable. It posted a $240 million net loss on just $514 million in revenue. So not a great, time for Upstart. It's a tough time for lending. Interest rates are rising, or interest rates have risen. The post-COVID demand boom has kind of cooled off. But long term, there's a lot to like about this business. One, it could be a big winner when rates fall as loan demand kind of comes back. And two, Upstart's really positioning itself for long-term success. It has over 100 banking partners, whereas a couple years ago it had just a handful of them. Um, it's rolled out other types of lending, particularly auto loans and home equity lines of credit on its platform. It's in 88 dealer rooftops right now. That's up from 27 a year ago. Its home equity lines of credits, the HELOCs, the median close time of an Upstart processed loan is 9 days as opposed to the 36-day industry average. And it's still in the early stages. That's only live in 11 states plus DC. Um, it looks really well. Looks like it's doing really well. So strong results so far in the business. If you're not familiar, Upstart's goal is to do a better job of approving loans for banks than the traditional credit models like FICO. Um, uh, I don't really want to tell you all the mathematics behind the chart you're seeing on your screen right now, but the general point is that so far Upstart's loan default data shows that when Upstart thinks that a borrower is good credit or bad credit, it's more accurate than the traditional models, FICO in particular. Um, Not a perfect company, like I said. Recent results haven't been great. I'd like to see them get stock-based compensation under control. It's way too high right now, but I do think Upstart still has a lot of long-term potential. Number two is Carvana, CVNA, 35% short interest right now. And unlike Upstart, this one has not been beaten down. This one has gone up by more than 1,600%, 1,600% since the start of 2023. And it's up for a reason. Revenue declined in 2023. Uh, Carvana was kind of thought to be on the verge of bankruptcy at the beginning of last year, but it did get its business under control. It right-sized its business. It cut some costs. It improved its net loss from $2.9 billion in 2022 to 150 million last year. That's really the big key right here. They kind of saved the business. They restructured some debt. They have $1.2 billion less debt than they did a year ago. The price to sales ratio is in line with what it was before the pandemic. So it's not like even though with a 1,600% gain, it's a really, really expensive stock. And it could have a lot of room to grow. The used car buying process is still not ideal. Most people don't want to go to a normal used car lot these days. It's a very fragmented industry, too. Uh, Carvana is one of the largest. They control just 0.9% of the used car market. Uh, the top 100 used car companies only have about a 10% market share today, so it's a very fragmented industry. A lot of consumer pain points to address, and Carvana does a good job with it. So I think it could be a good business for the long run. Third, last but not least, is Lemonade. LMND has a 32% short interest. And this is despite pretty strong results from the business lately. The big concern is that Lemonade's not going to be profitable. It's clear that its product is catching on well. It's growing fast. Um, its in-force premium grew 20% year over year in the most recent quarter, beat its own guidance. Gross earned premium was better than expected for the fourth quarter as well. Its loss was narrower on an adjusted EBITDA basis. Its loss ratio, which it targets to get under 75%, is getting much closer. It went from 89% in the fourth quarter of 2022 to 77% in the fourth quarter of last year. And so it's getting closer. Operating expenses are down. The company's doing a really good job. They are kind of stepping on the accelerator a little sooner than I would like them to see. One of their big things a couple years ago was, okay, it's not a great environment for growth. We're going to pump the brakes and focus on efficiency, which was a great move. But in their most recent shareholder letter, they said 2024 is going to be a year of growth. You can see in the chart here that they are expecting growth to accelerate to about a 26% year-over-year growth rate by the end of this year. But the company is saying that they are going to be cash flow positive by the end of 2025, adjusted EBITDA profitable by 2026, and it has almost $1 billion. It is $945 million in cash and equivalents in the bank, and this is about a $1.15 billion market cap company. So that's a lot of money in the bank to fuel its future growth. Now, just a couple of things to note. One, Lemonade's fourth quarter was very strong, but that's a seasonally good quarter for the insurance industry in general. When you think of most casualty losses happen during the summer months, not most, but an elevated level of casualty losses happen during the summer months. That's when hurricanes and things like that happen. So the first and fourth quarters are seasonally strong. So the real test will be, can they keep that loss ratio down during the second and third quarters of 2024? That's what I'll be watching. But all in all, I do like Lemonade. It's one of the stocks, along with Upstart, that I own in my own portfolio. Now, just a couple of things, a couple of housekeeping notes to mention. I wouldn't recommend buying any of these just because you think they're going to short squeeze. That's not the point here. These stocks, the short interest can remain high for a long time. They don't have to squeeze anytime soon. I think all three of these are going to be great businesses over the long run. They could get short squeezes, which would be kind of a nice bonus for investors. But these are three of the high short interest companies in the market that have a lot going for them. That the numbers are starting to look really good. They have a lot of potential and good management teams and things like that. So I'm excited to see where these three go over the next couple of years. Let me know in the comments which of the three you like the best. If you have any other concerns about them, I'll do my best to answer anything individually. But thank you for listening, and see you next time. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.